Get Rich Education is brought to you by Norada Real Estate Investments and Mid-South Home Buyers.
Welcome to Get Rich Education with Keith Weinhold, giving you information and ideas on the investment that has turned more ordinary people into millionaires and billionaires than anything else, and can provide you with more wealth and happiness than you ever thought possible. Now, here's your host, investor, entrepreneur, business owner, and educator, Keith Weinhold.
Welcome to Get Rich Education. This is episode 54. I'm your host, Keith Weinhold, and I'm back to help you build your wealth. Today, it's the third and final installment of the Building You series, where we're taking stock of exactly where you are financially right now, often numerically, and then we're looking tactically at how we can improve you. The first of the three Building You shows was about your net worth. The second one last week was about your personal cash flow, and today it's about your credit score. And we're fortunate to have America's top authority help us discuss this today with Philip Tirone from 720 Credit Score. In the credit scoring world, Philip will tell you that there's no scenario that he hasn't seen. As an investor, having a higher credit score, that opens up your investment opportunity. A high credit score gets you the best interest rates and loan terms, meaning you minimize your cost of capital, and in turn, you maximize your return on investment. And that's going to be true for real estate investment property loans, a loan on your own home that you live in, an automobile loan, and even in setting premiums with your insurance company. We're going to talk about how often employers check applicants' credit scores too. Okay, I hope that one doesn't scare you. A bad credit score, it does not make someone a bad person. They could have run into some unexpected, insurmountable medical bills or all kinds of situations beyond their control. But by not making some simple strategic shifts in your credit picture, you could be overpaying on every home that you ever own, investment property you own, the car you own, the insurance policy that you take out, okay? Now just consider this too. Even if you can pay cash for a car, today with auto loans as low as 3%, you've got to ask yourself if you can afford the opportunity cost of paying cash for a car when instead, with a great credit score, you can borrow at, say, 3% for a car loan today and invest the difference and pocket the arbitrage that you created because you have a good credit score to get that low 3% rate. And that's what I did when I bought my current car, the one that I drive now. Although I could have paid all cash for it, I didn't want to pay the opportunity cost of doing so, okay? Knowing me, you probably knew that I was going to say something like that. I put zero down on the car, borrowed the entire amount at a 3% interest rate so that I could buy more leveraged cash flowing real estate that typically yields 20+%, borrowing it at 3, investing it at 20+. You might remember when we had mortgage loan officer Graham Parham on the show for episode 40 when he told us that you need a minimum credit score of 720 to qualify for your 5th through 10th investment properties, and 720 is a significant threshold for a lot of other loan types. Even if your credit score is already higher than 720 or even substantially higher, you're going to learn how common credit score errors really are. So you're going to want a good cushion above 720 if you can, because that way if an error comes onto your report, you can see that it will not drop below 720. Now, a while back, I was actually considering whether or not I wanted to do a credit scoring episode, and really didn't take me long to think when I considered that a credit score now is probably more important than it was 10 plus years ago. It was kind of an easy choice for me. Prior to the mortgage meltdown in 2008, 2009, getting a real estate loan was often so easy that you only needed to prove that you were alive. Credit scores didn't matter so much then, but today you have to have your financial ducks in order. And that includes your credit score. And that doesn't matter. I mean, even if your annual income is several $100,000, okay, oftentimes it doesn't matter. You still need to have a good credit score. Well, besides needing to have a good credit score, the reward for having a good one today is better than it was more than 10 years ago, because now you're going to be rewarded with interest rates that are still at historic lows here. So credit scores are more important today than ever. Now, I've never missed a payment of any kind in my life. I've never even been late on one single payment in my life, but I know that I'm going to get a lot out of this show today because credit scoring is often counterintuitive. Just like I said, you often want that cushion. So let's go ahead and jump into our discussion. It's my pleasure today to bring you Philip Tirone, owner of 720 Credit Score. And I've regarded Philip for a long time as a preeminent authority anywhere on what it takes to get a good credit score and really understanding this game. And it really is a game because it often defies reason and rationale. And I've never had credit score problems myself, but this applies to you even if you haven't had credit score problems, and you're going to see why. And I think today you're going to learn more about credit scoring than you ever have previously. And this won't just help you with your real estate investing, but it's really going to help you everywhere. Even if you have an insurance policy or a car loan, there's so many places where credit scores permeated society. So I'm really fortunate to have him today. Welcome to Get Rich Education, 720 Credit Scores, Philip Tirone.
Hey, Keith, how you doing?
Hey, great, Phil. You know, it's really good to have you on. So what angle did you approach this from? How did you get into the business of really being a renowned credit scoring expert?
So, Keith, first of all, before I jump into that, thank you for having me on your show. I mean, I know how big your listenership is and how well regarded your show is. So, first of all, thank you for that. This is a great opportunity for me to, spread the information on credit scoring.
I appreciate that.
Absolutely. So, here's the thing, is like most people, it all started in 1997. I went into a bank to deposit a check, and I was actually overdrawn on my checking account. And the lady said to me, well, why don't you have an overdraft protection line? And you can get it. It costs nothing. All we have to do is run your credit score. And I thought to myself at that moment, well, great. I don't have bad credit. I pay my bills on time. Surely I'll get approved. She ran my credit score. Boom, you're denied. And let me tell you, that was an embarrassing moment. I could literally picture being at the teller. And she said, you're denied. And I was in the mortgage business. I went back to my credit score. I ran my credit report. And it's not like I had bad credit. I paid my bills on time. I had one thing from college, I believe, on my credit report. But because of that, I was overpaying on things. And that's when I realized, being in the mortgage industry, fundamentally, I need to figure out this credit scoring system so I could help my clients get the best mortgage possible. And that's as simple as it is, Keith. The bottom line is credit scoring is this black hole. Everyone thinks you pay your bills on time, you're going to have great credit. It's not the way it is. You can pay your bills on time perfectly and be overpaying hundreds and hundreds of dollars a month. And it's just the way the system is set up, and it's really rigged against us. Because you got the credit bureaus who are paid by the banks, and the banks make money based on your credit score. So it's a big game and manipulation play that basically I'm just trying to expose the truth.
So, Phil, let's talk about why this matters. I mean, what are all of the places in society where a strong credit score can help you today, or where a weak score can hurt you?
Here's the thing with regard to credit scoring. It's obvious the car loan, the home loan, the credit cards and things like that has a negative impact on your credit score if you don't, or that you will overpay if you have a net low credit score. What you may not think of is your car insurance. In many states, your car insurance or your insurance carrier will run your credit report to determine if you're going to be at higher risk to them. Also, with regards to employment, 61% of employers, according to Inc. magazine, run your credit report prior to hiring you.
Wow.
Now, a lot of people don't understand this. This is critical, what I'm about to bring up, Keith. Just because you have bad credit doesn't mean you should not apply for the job because of this stat. What you need to do, if you're going to apply for a car loan or a home loan or rental, and you just had a bankruptcy, a foreclosure, or whatever it is, all you need to do is speak into that, right? The fact that you're rebuilding your credit, you understand this, you understand that. You would be surprised at the people conducting the interviews, the people approving the rental, chances are they have bad credit or they've had bad credit, and you can teach them.
Yeah, I think I've heard you regarded basically as a monumental scam with the whole credit scoring system.
Yeah, well, I mean, it really is. Those are strong words. And I choose my words very specifically. A monumental scam. If you knew what I knew about credit scoring, if you could see the people who, because their credit card company is reporting the wrong credit limit, because they're reporting the wrong credit limit, has nothing to do with the borrower. And that borrower comes in and is now overpaying on their mortgage month in and month out because that credit card company's credit limit, improper reporting the credit limit, which, by the way, happens 46% of the time. We'll get into that later. It is a scam, and it really is. And unfortunately, people think of credit repair as, oh, we need to fix bad credit. It's not about fixing bad credit. It's not it. This is about a basic education around credit scoring. If you understand the basic rules around credit scoring, you will never overpay. It goes without saying, you got to pay your bills on time. So the average person pays their bills on time. We got to understand the rules.
And part of understanding the rules of this game, or even scam, if you will, is the fact that trying to wrap one's mind around the fact that you can have blemishes on your credit report, significant blemishes and black marks against your credit report, but yet at the same time, you can have a high credit score.
Oh, yeah. I mean, one thing I've said hundreds of times, you don't need a clean credit report to have a high credit score. And a clean credit report, meaning no late payments, no collections, will not guarantee you a high credit score. That's the reality. I mean, it does not matter what happened in your past. It doesn't matter if you got a foreclosure and a bankruptcy yesterday. You can have a 720 credit score in 12 to 24 months after that event. The best part about our credit score is the fact that you can rebuild it easily if you understand what's done. And if you don't need to rebuild it, there's simple techniques you do so you're making sure that you're not being manipulated by the banks.
Okay, so what's a typical scenario or a client that comes to you that needs help and, they have a credit score of, say, 630 or something, and they want to get their credit score up to 720 to qualify for a mortgage loan or for some specific purpose? What are some of those repair things that you do to elevate their score?
Okay, well, so I got to back up a little bit. So let's talk about that. So let's say someone comes to me and has 630 credit score. The first thing they're going to learn is we got to assess where they're at. Someone with a bankruptcy or a foreclosure is going to have to rebuild their credit score differently than someone that just doesn't have a bankruptcy foreclosure. So there's two big aspects here. One, do we need to rebuild your credit score or the person's credit score? And if they need to rebuild it, so what I mean by that rebuild, they had a major impact, foreclosure, bankruptcy, multiple delinquencies. Okay, from that perspective, we need to rebuild around their bad credit. Now, this is a key distinction, Keith, and I want to make it very, very clear to your listeners.
Okay.
A lot of people think they need to get something off their credit report, like we said earlier, right? It's a waste of time to get something off the credit report that is legitimate. This goes in the face and flies in the face of all these credit repair companies out there. They say, oh, we got to dispute this, dispute that, dispute that. Let's write letters and let's get it off the credit report. Well, first of all, according to the FTC at ftc.gov, you can see that it is absolutely illegal to dispute something on your credit report that you know actually happened. People come to me all the time and say, hey, I have a bankruptcy on my credit report. How do I get that off? Well, my response is, was that bankruptcy legitimate? Did you actually have it? If they say yes, I say to them, don't try to get that off your credit report. Let's rebuild around the bankruptcy. It doesn't matter if bankruptcy is on your credit report. We just got to rebuild around it to get that high credit score because, like I said, it's illegal to dispute something that actually happened. So first of all, that's what I would do if someone had a major delinquency or something. We'd start rebuilding around it. If someone doesn't have a major late or delinquency and they have a low credit score, it's because they're not playing the game. What typically that is, it's because one, they don't have enough credit. Two, their credit card companies are not reporting the proper information. And as I said earlier, according to a Federal Reserve Board study, 46% of credit cards that you have in your wallet, 46% of the credit cards that are out there do not report the proper information to the bureaus, which has an impact on your credit report.
That's astonishing.
I mean, 46%. It just drives me nuts. This is what I'm talking about, the manipulation. I mean, think about that. 46% of the time, your credit cards are not helping your credit score, or they're having an impact.
Okay, well, I'm listening really carefully to the words that you choose here, and just to kind of get it in my own mind and summarize for my audience, you're not into credit repair, because credit repair, that implies that you're going ahead and trying to do something illegal, which is removing something off the report that should be on the report. Instead of repairing, you're rebuilding around that.
Yeah, so here's the problem. The problem with credit repair, it's a really dirty, dirty industry. See, so here's what happens with credit repair. You see signs on the side of the street, credit repair, call this number, right? They work out of their car. They say, hey, give me $2,000 up front, $3,000 up front, and we're going to get this off your credit report. And you're like, well, how do you do it? Well, I can't tell you. That's what they say, right? I mean, I know because when I see these numbers on the side of the road, I used to call them. I don't call them anymore. I mean, I've been down this road. I mean, I know what they say. You can go to these sites that say, hey, we're going to give you all the letters to dispute everything on your credit report for $49. Well, newsflash, the credit bureaus and the banks that fund them are hip to that game, okay? 15 years ago, that worked. Nowadays, it doesn't work, let alone it's illegal. So first of all, it doesn't work. Second of all, it's illegal. What I want to do, and this is my mission, this is what I try to point out, is that one, if you knew who had bad credit, people wouldn't be embarrassed about their bad credit. Like, it's almost like something that they don't talk about because they're embarrassed about. But if you saw the people like I saw who had bad credit, no one would be embarrassed about it. Everyone's gone through the frustrating parts, the tough times in life. And second of all, it's easy to rebuild your credit. And three, if you've never had a late payment, you've never had a foreclosure or bankruptcy, your credit score better be 750, 780, 800, or you are going to overpay when an error pops on your credit report and it drops below 720, coincidentally at the time when you're applying for a loan. And guess what? If you don't understand the games now, you're going to overpay when that time comes.
You mentioned that it can be relatively easy to rebuild a credit report and a credit score once you know the game. A word that I've often liked is elastic. I think credit scores are a lot more elastic. They could move around and be manipulated quite a bit more quickly than most people think. You brought up a couple things earlier that prevent people from having a higher credit score. One is just simply not having enough credit, and the other is the credit agencies, or the banks rather, reporting the wrong info perhaps to the credit agencies. So what about that first thing? What can someone do that doesn't have enough credit? How can they optimize that?
Well, the key thing is you need absolutely, without a question, 3 to 5 credit cards. People typically say, I don't carry credit. I didn't say you should carry balances on the credit cards. But what you need 3 to 5 credit cards. Absolutely, period in the story. I don't care if one of the credit cards pays your DirecTV bill or your cable TV bill, and then the rest, it's paid automatically out of your checking account. You don't have to carry balances on these credit cards, but you have to have between 3 to 5 credit cards. That's the first thing to grow deep roots. Think of your credit scoring system like a tree. The deeper the roots, the better, because according to 60 Minutes, this was a 60 Minutes segment that was on last year, 40 million Americans have an error on their credit report. Now, according to that U.S. Public Research Institute group, 25% of errors are so bad that if you applied for a loan today, you would be denied. So I'm not talking about an error that drops your points 2 points. I'm talking some of these errors drop your score 2 points. Some of these errors drop your score 150, 200 points that you would be denied. I can assure you, Keith, there's some people listening to this that believe that they have bad credit where they really don't have bad credit. They think they have bad credit because they applied for something in the past, they were denied, and then they created a story in their head that they had bad credit. And that's how this works.
So, you mentioned the deep roots. Having 3 to 5 credit cards is the optimum number to get those deep roots. And with the other thing, reporting the wrong information, how do we make sure that the right information is reported?
Well, that's the key. You got to find the right credit card. We have credit cards that actually help your credit. So there's 2 things when it comes to credit cards to make sure that your credit score is being impacted. One, they report to all 3 bureaus. Not all credit cards report to all 3 bureaus. The second thing is that they report the proper credit limit to the bureaus.
Right.
Not all credit cards report the proper limit. So at our website, we have credit cards that do those 2 things. If you go to creditcards.com or you get some credit card solicitation in the mail and accept it, they may not report the proper credit limit to the bureaus. And that has a significant impact on the credit score. Let me explain why. Say, for instance, you have a $1,000 limit. One of the key factors in credit scoring is how much of the limit you're utilizing. So if you have a $1,000 limit and you charge $100 a month and pay it off, you're using 10% of it, it's going to help your credit score. If you use $100 and the credit card company is reporting 0 limit, that happens all the time, then it's showing that you're maxed out, which has a significant 20, 30 point impact on your credit report.
So not only do you want 3 to 5 cards, you want the right cards. Because one thing that I've come to understand is, for example, American Express is a little bit different. They're not going to go ahead and automatically report your credit limit to the 3 major credit reporting agencies.
Well, it depends on the American Express. Sometimes they do. Sometimes the cards they do report. Sometimes there's many American Express cards that have no preset limit. And if it's a no preset limit, what they do is they report your highest balance ever. So it can get confusing. I go in deep in all this information at 720creditscore.com.
We're talking about utilization ratio, just to clarify for people. So we are talking about the balance divided by the available credit that card allows you, which is a pretty key component of your credit score or your FICO score, right?
Yep, key component.
Okay. And FICO there, FICO, Fair Isaac Company, for those that don't know, that is still the score that matters, right? And that's the one that mortgage lenders are most likely to check?
Yeah, well, that's true. The short answer is true. And this is where it gets confusing as well. So when I rewrote my latest episode on credit scoring, I went to TransUnion, bought 3 scores. Equifax, bought 3 scores. Experian brought 3 scores, went to MyFICO, bought the scores, and went to annualcreditreport.com and bought the scores. Annualcreditreport.com at the time, that day, was off, but I bought all my scores on the same day, and not one was the same. If I'm going off memory, I believe it was a 227-point difference from the lowest score to the highest score. 227 points on the same exact day for the same person with the same Social Security number. I mean, think about that, right? I mean, it's just so unfair and untruthful. That's what drives me nuts about this whole thing. So my point is yes, the FICO score is what mortgage lenders use. There's different scoring criterias, for if you're getting a car loan, home loan, renting a property, there's different scoring criterias. But in the end, FICO is very, very, it's what's regarded in the home industry. It's typically harder to get a FICO score up, which is why we default there.
You're listening to Get Rich Education. My guest is 720 Credit Scores Philip Tirone. More when we come back. I'm your host, Keith Weinhold. Cash flow real estate investors nationwide and worldwide, this is Get Rich Education's Keith Weinhold. Forbes has rated Memphis, Tennessee as the #1 cash flowing market in the world. Our good friends at Mid-South Homebuyers have been Memphis's premier turnkey real estate provider for 14 years with a stellar reputation and an A+ rating with the Better Business Bureau. Owner Terry Kerr was born and raised in Memphis. Yeah, he knows the market and has renovated and sold over 1,000 houses in the Memphis area. Find out what their many repeat buyers already know. Their houses are completely renovated, even come with a 1-year builder's warranty and a lifelong rental guarantee. They're a perfect fit for the first-time out-of-state investor or the seasoned investor diversifying their portfolio. Mid-South Homebuyers' friendly staff makes investing easy. Learn more at midsouthhomebuyers.com or give them a call at 901-217-HOME.
Are you having a hard time finding great investment properties? Unfortunately, the best deals are rarely found locally. Successful investing begins with the right properties in the right markets. Norada Real Estate provides everything you need to invest in the best deals across the U.S. Our simple, proven system will help you create real wealth and passive monthly cash flow. Get your free copy of the ultimate guide to passive real estate investing at noradarealestate.com/guide. That's NORADA realestate.com/guide.
We're Rich Dad Advisors, Josh and Lisa Lannon.
Be who you are becoming. Listen to Get Rich Education with Keith Weinhold.
Welcome back to Get Rich Education with my feature guest, 720 credit scores, Philip Tirone. Now, Phil, does the discussion that we're having, does that apply just to the United States, or how well does this resonate worldwide?
So it really depends on the country. I've had people use our system in Canada a lot. In fact, in our program, we actually have a Canadian lesson specifically for Canadians. I've had people from Britain use it. But for the most part, it's an American and Canadian system that is heavily overlaid on other highly Western developed countries like Britain and Australia.
Well, I think one influential place where people that are somewhat in the know go to get their credit scoring information to help guide their decisions are the pretty influential myfico.com website, a site that I've gone to many times. And for years at MyFICO, they've had that pie chart there of what the ingredients of your FICO score are. I don't remember it exactly. It's something like 35% of your score is made up of your payment history, 30% of your utilization ratio, and then some others. I mean, can one put a whole lot of faith in that chart with guiding their decisions?
Well, so let's just talk about that, because this is something that every financial guru out there who's talking about credit score talks about. It says 35% has to do with your payment history, 35% has to do with your utilization rate, 10% has to do with inquiries. And people get way too caught up into that. It's sort of like, imagine going to the doctor for migraines and you get medicine. You're not trying to solve the problem. Why are you having the migraines? Why are you having the headache? So one of the things I say often to my clients, I'm like, look, don't worry about anything else, any of the fodder out there around credit scoring. It's really, really simple. The first thing you need is you need to have 3 to 5 credit cards. You have to have that.
Okay.
The second thing you need to do is make sure you have the right credit cards. The credit cards actually help build your credit and not hurt it. Third thing, you need to make sure that all errors are off your credit report. Fourth thing, you need to have a paid or installment loan. If you don't have an installment loan, it's gonna have a negative impact on your credit.
What's an installment loan?
Installment loan is like a car loan, a furniture loan, a type of loan that is paid in equal monthly payments for the life of the loan. And you don't even have to keep it the whole time. We teach our clients, get a small $1,000 installment loan from a local credit union and pay it off in 6 months. If you have the right credit, you make sure you have the right credit cards. You make sure you have no errors on your credit report. You make sure your installment loans are off. And then you have a structured plan. Make sure there's no errors on your credit report and protect your credit. You're done. It's really that simple. And you can't get caught up into trying to figure out all these little nuances. And that's what the pie chart does. It's more of the black hole, which is perpetrated by the credit bureaus for the banks.
I think more so than what some people might do just based off the pie chart. You know, you look at utilization ratios of credit cards a lot in shaping the score. I think you were talking about, I've heard you discuss before how there are percentage breaks, percent utilization ratio thresholds, which you want to be under for score improvement. What are those?
So we're going back to utilization rate. Let's say you have a $1,000 credit limit. In our program, we teach that you want to keep your utilization under 30%. That being said, if it's under 10%, it actually helps your credit more than if you keep it under 30%. If your utilization rate is 0, it helps your credit score even more. If you go up the other way, if you're using 50% of your credit limit, It's going to have a negative impact on your credit report versus 30%, and then 70 and 90%. So all the thresholds are 90, 70, 50, 30, 10, 0.
Okay.
The key thing is, instead of overthinking it, keep everything under 30% and have that with 3 to 5 cards.
Okay, that would be the ideal scenario. But you said 0% utilization is actually ideal, even though it might not be realistic for someone that's going out and living life and charging things. Or
0% utilization is not realistic for anyone who lives in the real world.
Right.
I mean, because utilization rate is making sure that it's not that if you pay off the car, you pay off your credit cards on a monthly basis, right? A lot of people say, oh, I don't have to worry about utilization rate because I pay my cards off every month. Well, that's not true. If you carry any balance at any time or you're ever using your credit limit, you're utilizing that card. But so that being said, if you know you're applying for a car loan on fill in the blank, June 1st, and you need every point of your credit score because you say you've had a bankruptcy, a foreclosure, or something, and you just need to be boosted as high as possible, what I recommend is go in, make sure you pay off all your credit card bills the week prior and don't use them for a week.
Okay.
Pay cash. It'll actually have a big impact on your credit score as opposed to going in with any balance.
Okay, so that's like for the borrower, just taking it down to the surgical level for just a week or so to sort of optimize things and then relenting.
Exactly.
So just before we leave the utilization discussion, just to make it really clear for our audience, if you have a credit card with a $1,000 limit and say you're carrying a $1,000 balance, if you pay it down to a $900 balance, your score could improve. Or if you pay it down to a $700 balance, it's at 70% break, it will improve some more. If you pay it down to $500 on a $1,000 limit, it's 50%. It's another break. It'll improve it 30%, 10%, and so on.
Right.
Got it. A lot of people are concerned with the number of credit inquiries that are being made against their account and how that's going to ding their score. Is there a way to optimize the fewest number of inquiries? And what is an inquiry?
So an inquiry is let someone run their credit report. And there's soft inquiries and hard inquiries. Hard inquiries is when, Keith, you're going to a car dealership and saying, please run my credit. Soft inquiries are when a credit card company that you have is using credit report to make sure you're not behind on any bills and stuff like that. Soft inquiries have no impact on your credit report. Hard inquiries have an impact. That being said, inquiries are something I get asked about all the time, and people should stop worrying about. They should just stop worrying about inquiries. If you're worried about inquiries, you're not playing the game correctly. And there's not one part of my program that talks about inquiries, because it doesn't really matter. I mean, if you're worried about inquiries, you don't have enough credit built up to really help you.
So basically, you need to focus on other areas then. So with some of those other areas being errors and removing errors, I guess if one might have a number of errors on the report, is there a way that you prioritize the errors, or what's been most costly to you in having a good score?
It's not something, we just have the time to go into here, but we have high priority errors and low priority errors. Low priority errors are things that just don't matter. Could be a late payment that you have on your credit report from 5 years ago. It's a low priority error. Even if you think it's wrong, unless you can easily prove that that's a mistake, I wouldn't even waste your time with it. High priority errors are things like credit limits improperly reported, collection agencies reporting 2 or 3 times the same collection, things that are having a big impact on your credit report. Those are big things.
Now, say one listener here already has a good credit score. Say their credit score is significantly above 720. I mean, your company's called 720 Credit Score. Can you really provide help to someone that really doesn't have a lot of credit problems?
You know, if someone has a 720 credit score and they don't have any bankruptcy foreclosure on their credit report, I'd say you have credit problems. Because statistically speaking, an error is going to pop on your credit report and you're going to be stuck on it. And you're going to have to realize you have to do something. You have to do something to rebuild that credit score and get that error off. So I think credit scoring should be something that everybody teaches their kids. Every high school should teach us before they go out and get credit cards, because it's just simple things that you need to understand. It's not rocket science. It's really, really simple. But if you don't do this, then unfortunately, your chances are you're going to get a credit card. I mean, 46% of credit cards out there have an impact on the credit report. You're going to be led down the wrong path. And I think that's what I'm getting at.
So if a listener has a collection on the credit report, they see that on there and it is a legitimate collection, is that something that they should pay off right away?
So I'd have to ask a bunch of questions on that. One, is the collection real? Second of all, how old is the collection? Third of all, when is the person going to get another car loan, home loan, some type of loan? All those things really matter to determine if you should pay off a collection. One thing that people don't realize, and this is a really key point to bring up, is that a paid current collection, so let's just say someone has a collection. A paid current collection is worse than an unpaid collection that's over 2 years old.
That's outrageous.
Yeah, I mean, it's just hard to believe. So I have a collection with Verizon. Say, for instance, I had a cell phone. I didn't realize it sent me the collection. 2 years went by, and I have this collection. Paid current collection is worse. If I pay that collection 2 years old, it's going to hurt my score rather than keeping that on. And, this is why you have to negotiate the right way with that collection company. It may be better for you not to pay that collection. And now, I'm not saying, I want to make it clear, Keith, I'm not saying don't pay your bills, right? Big advocate in paying what you need to pay. But you don't want to pay this bill before you're getting a car loan, a home loan, or some type of loan, because it's going to have a negative impact on the credit score.
I think that's the biggest takeaway right there. The fact that should you or shouldn't you pay a collection off right away? If the answer is it depends and you shouldn't necessarily pay off a collection right away, that's very telling right there that there's a bigger game behind this and there's quite a bit more to understand.
Yeah.
Now, one thing I've noticed that's changed in the industry in the last few years is, it was quite a few years ago now that, was it a government agency or someone that demanded that, consumers have the right to get a free annual report each year, which I think it's actually not at freecreditreport.com, right? You pay for that one. There's another source where you can get a free credit.
Yeah, annualcreditreport.com.
Okay, so that's something very actionable our audience can do today. Go to annualcreditreport.com and see what they've got there and see if any errors jump out. Is that a good early course of action?
Let's unpack that statement a little bit.
Okay.
First of all, this was legislated. So politicians, in their all-knowing wisdom, said to the bureaus, well, you need to give someone a free credit report every year. So they legislated it. So the problem is you get a credit report, you don't get a credit score. So everyone gets judged based on one thing. It's the score, not the report. So if you go to annualcreditreport.com, you get the report, they're going to offer you to pay $15 for the score, which once again is given to the bureaus, right? In some capacity, they're lining their pockets with that money.
Right.
Then you're going to get a wrong score, because they don't use the same scoring criteria as like a FICO. So this false sense of security comes in play. So the whole conversation of should you go to annual credit report to get the report? Well, yeah, you should, but you're going to get on the report these things like not enough credit limit, not high enough credit score, all these computer-generated responses, which more than often than not confuse the person. The problem is fundamentally, it's so broken. And from a lobbying perspective, just look at this billion-dollar game. You have three credit bureaus, the Experian, TransUnion, Equifax. They earn their money by charging banks to run a credit report and compile all this data to tell the bank if this person's credit worthy or not.
Right. That's their mission. That's what they're there for.
Right. So the bank, based on that data, is going to determine, Keith, whether you get a 3% car loan or a 10% car loan.
Right.
Is it really in the bureau's best interest to teach people how to improve their credit score?
No, because that would just be less interest that the bank could charge.
Right. And let's just put this in real dollars, okay? Person A is going into getting a car loan. You're getting a $15,000 car. They have a 720 credit score. Their interest rate, according to my FICO, is around 3% right now.
Okay.
If that person has a 659 credit score, 61 points lower. That interest rate jumps to 10.44%. That's a 7.44% increase. 7.44% increase for 61 points. Now, a 659 credit score, it's not like that's a bad credit score. In no way would a normal person think that a 659 credit score is a bad credit score. So you're going from a 3% to a 10.44%. You're paying $100 extra on a $15,000 car because of a measly 61 points that can be lost with 2 credit cards that are reporting the proper limit.
Yeah, that's just so incongruent with what a score should really represent.
It lacks so much integrity, it drives me nuts. So while we're talking about this, other people are talking about the pie graph with 35%. You see what I mean? Like, it's fundamentally, we're talking in 2 different games. FICO's talking about, your credit limit has to do with 35% and your payment history 35%. But it has no bearing on how to improve your credit score. And why? Because the bureaus are paid by the banks. The banks don't want that. They don't want to teach their client. It's just not in their best interest. And the thing is, I think we need to understand, it's not that the banks are bad people. I'm not saying that. It's just our interests are not aligned.
Right.
Their interest is to increase their profitability for the shareholders. It's not bad. It's just not your interest. It's not in your self-interest.
Sure. Yeah. The banks just don't have a motivation to want to help clarify things for consumers.
Yeah, that's all.
Yeah. Once you know how it works, you can understand why the system might be pretty unclear. So it's really remarkable to get all this stuff out there. Well, just in winding down here, Phil, is there really any last thing our listeners ought to know about credit scoring? Any last takeaway?
Well, I think just, before you're going to get a loan, before you're going to get a car loan, a home loan, or whatever, do some due diligence 6 months in advance. Because what you can do in 6 months and 4 months and 3 months and 2 months, even 30 days, you can do a lot in reshuffling your credit in a short amount of time. Just do your due diligence.
Hey, well, that's great, Phil. Thanks so much for coming on, providing value. What's a great way for our listeners to find out more about you and your resources?
Well, I'm at 720creditscore.com, and we got a ton of free information out there. And just check it out. We send out a weekly newsletter every Sunday with credit tips and stuff like that. And, this is something that it's not forever. When you understand the basics, you'll never have to think of credit again.
Yeah, well, Phil, this has been extremely eye-opening, and thank you so much for coming on to Get Rich Education today.
Keith, I'm grateful that you had me on. I'm grateful that you would bring me on because I know your listenership is so active and so big. So I'm so grateful.
Well, I hope you got a lot out of that today. Just to review one takeaway, to establish deep roots, you want to have 3 to 5 credit cards and 1 installment loan. Credit scoring is certainly less intuitive than a lot of other things. I think Philip spends more than half of his life dispelling myths. So again, you can check out Philip's resources at 720creditscore.com. These past 3 weeks, we focused on you in somewhat of a micro sense. Next week, we're going to host a guest on the show who coined the term, or, well, at least authored the book, titled The Philosophical Investor. We're going to discuss how you think about investing and probably also go bigger picture with discussing macro monetary policy next week, inflation versus deflation, quantitative easing, and a lot of that as it relates to real estate investing. The week after that, I'm going to bring the owner of a mortgage company onto the show. And this is a company that has a proven track record of having helped more families realize their dreams of financial independence than any other mortgage lender in the country. And what I'm going to do with the owner of that company is we're going to go over line by line what real estate closing costs are and where each individual closing cost comes from. That ought to be a valuable show. Hey, well, what did you think of the first whiteboard instructional video that I appeared in? For all of you newsletter subscribers, I hope that you liked that video that was sent to you last week. Of course, it's not the first one I ever appeared in, but it's the first one that I ever sent to my newsletter subscribers. And, I've never seen anyone teach that particular concept that I laid out there. And, that's just another reason that real estate investors get wealthy in their sleep. And that was in a way that most experienced real estate investors don't even know about. So you can keep up with that by subscribing to our free newsletter yourself by going to GetRichEducation.com. Hey, special thanks today to Philip Tirone. I come to you every Friday to help you build your wealth. I'm your host, Keith Weinhold. Thank you for joining me. Until next Friday, don't quit your daydream.
You've been listening to Get Rich Education, telling you what the wealthy won't tell you about real estate and investing. If you enjoyed the show, please take a minute to visit iTunes and leave your comments.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.